Hello, everyone. Today on the final bar, the S&P back below 4550s. For now, unable to hold that key level. Jesse Felder is going to talk to us about precious metals, some areas of the market we may want to start focusing on. And finally, one key defensive sector at the top of the list today. Is this the beginning of a rotation more to defensive positioning? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. I had a lot of great conversations with clients, with peers this week, talking about the market conditions. And what I was reflecting on some of these conversations is that the technical toolkit is really about what is happening. It's about having an open mind, open eyes, and open ears, and really just having a good market awareness, a good sense of what's working and what's not. How often do we fall into that trap of talking about what should happen or what could happen or what may happen? And all of a sudden we get drawn into all sorts of behavioral biases because we're driven by that narrative and no longer driven by the evidence. Charting and effective charting, I would argue, is all about focusing on the evidence. The market is providing us information. Let's focus on gathering that evidence, that information, and see where we can place our bets as appropriate. We're going to have a great show today. We have Jesse Felder of the Felder Report live in the studio, which is always a lot of fun. We'll talk about precious metals with Jesse and look at some of his favorite charts. But to start with, we have to wrap the week. Let's get to our Wrap the Week segment and focus on what has happened in the markets this week. Before we kick that off, let's answer a poll question. We asked you recently, where is Apple 1 month from today? If you have a crystal ball for Apple, where is it 1 month from today? At least 10% higher, at least 10% lower, or within 10% of current levels. 43% of you saying within 10%, 36% saying at least 10% lower, 21% saying at least 10% higher. Let's check out the chart of Apple and actually see what sort of movements we've had. So what's so interesting about a chart like Apple, of course, it's making new all-time highs here. This is the weekly chart of Apple on the right. You can see this move to the upside. Of course, an incredibly orderly uptrend, although sort of pulling back here in the in 2022, but a nice resumption of the uptrend and really making a new swing high here, almost to $200 a share, but not quite there. When you look at the daily chart, you can see it's really, out of the average stock we might bring up, Apple has probably been one of the most consistent uptrends. If you look, higher highs and higher lows, just a nice consistent pattern. This yellow line here is the 13-day exponential moving average. It's pretty much just kept pulling back to that and then making the new swing high, and that's sort of continued this whole time. Today, we're kind of closing right down to that 13-day EMA, and again, with a chart like this, I'm inclined to assume it continues until it doesn't. So while looking forward a month is an interesting, academic exercise, I would argue the most important thing you can do over the next month is to focus on the chart. If I had to vote, I would probably say within 10% of current levels. And the reason is this: 10% above current levels seems pretty aggressive. That would take us even further above $200 a share. And I don't see that as a likely scenario given how extended a lot of these charts are. Apple having a bearish momentum divergence right now. Are we going to go over 10% lower? That's possible, but I would say unlikely, because imagine what happens when Apple pulls back 5 to 10%. How many people missed out on Apple that are going to be really excited on buying some short-term weakness? I wouldn't be surprised if a month from now we're about similar to current levels with a lot of noise between now and then, but that would be my guess. Thanks so much, everyone, for answering that poll and thinking about the future path and the probabilities involved in a chart like Apple. Let's continue on our Wrap the Week segment. Let's look at what happened in the markets today, and then we'll look at the weekly returns and see how today's move fits into the big picture. Just really quickly, the S&P essentially flat for the day, chopping around quite a bit, but directionally we were at a certain place yesterday around 45.36, and we're right back there today, just a little bit above yesterday's level, but essentially unchanged for the day. Same for the Dow, came off a bit in the afternoon. Both of these indexes were up earlier in the day, but by the afternoon kind of rolled over in the last hour of trading, and both of them finishing about unchanged for the day. The NASDAQ Composite and the NASDAQ 100 both down about 0.2 to 0.3%. So not a horrible day in either direction, but pulling back just a bit. Mid caps and small caps in the red as well. Volatility going down. So you had a bit of a choppy day, but not a volatile day, right? If you look at the percent moves involved, not a huge move to the upside or the downside. What's interesting is you're going to find a couple sectors that actually had a fairly decent move. We'll get to that in a second. Interest rates overall moving a little bit down. You can see the 10-year yield around 384 to finish the week. The long bond yield around 391. 5-year yields remaining above 4%, around 4.1%. And again, that chart of the 10-year is what I keep coming back to. It's so interesting how 10-year yield got up to around 4.25, 4.25, came down to around 3.25, and now we're almost kind of right in the middle of that range. So the fixed income market has felt more range bound than in any particular trend based on my read of the charts. It's been sort of choppy sideways. And what that tells me is if and when the 10-year yield starts to go higher, if all of a sudden we get back up above 4%, what does that do to the forward-looking sort of mentality in a growth stock, right? A big growth stock, you're basically pricing their future earnings back to today. And if rates go higher, those future earnings a little less attractive. That kind of makes the growthy part of growth a little less awesome than it was before rates go up. So that's sort of the risk to the growth story that we've been enjoying so much here in 2023. Dollar index up a bit, about 1/3%, so nothing too crazy to worry about. Commodities, a bit of movement, but nothing horrible. Gold down about 0.3%. Silver, the SLV was down 0.5%. The broader commodity ETF we like to track, the DBC, was up about 0.5%. Crude oil prices pushing a little bit higher. Energy, not a bad day. We'll look at sectors here in a minute. Just to finish off, cryptocurrencies, pretty much sideways. I would say Bitcoin and Ethereum not too far from where we were yesterday when we went with the show. Bitcoin just below 29,900. Ether prices just below 1,900. I think the bigger story with things like Bitcoin and Ethereum, we haven't featured the chart on the show too much recently because sort of broke above 30,000 for Bitcoin, broke above 2,000 on Ethereum. We drew back from both of those breakouts. And for now, it's sort of wait and see mode. I think these charts are more sort of, it's like you hit a pause button on the trend and we wait to see what happens. You have to remember at any point, a chart can go one of three ways. It can go up, it can go down, it can go sideways. I had a great conversation with Dave Landry last week about that particular, three-pronged approach to trend analysis. I would argue with cryptocurrencies, which is normally a quite volatile space, it's more sideways than anything, right? We sort of, we're pausing and we're waiting to see if that uptrend can reinitiate. And I think Bitcoin gets above 30,000, Ether gets above 2,000, then it's a different chart and more of a breakout sort of move that we want to focus in a little more, but not happening just yet. When we look at sectors, I hinted in the intro, one of the defensive sectors doing well, utilities back at the top of the list. Now, I will tell you, when we have an extended bull market, which we do right now, and you start to see a defensive sector like utilities pop up at the top of the list. Not the end of the world, because utilities, if you look back at times have led in bull markets. That's not unheard of. But after they've been underperforming for so long, as they've been languishing on a relative basis compared to some of the growth sectors like technology and communication services, something like utilities all of a sudden pushing aggressively to the upside tells me that someone or someone's, a large group of people, and certainly a large group of capital, is rotating into more defensive positioning. And those are the sorts of things that are sort of red flags that pop up as I see that sort of data point, similar to bearish divergences or breadth that is extremely positive and starts to come off a bit. Just tells me maybe we have a change of character. And I think going into next week, the performance of utilities may be an important indication to look at. Could line up with rotation lower in growth, which we've certainly seen some signs of this week. Do we see further appreciation from some of the defensive areas of the market? Utilities today up 1.5%, healthcare number 2, and energy number 3, all of them up 0.9% or more. Only 4 of the S&P sectors were down, and only 3 of them with any significant amount. Communication services, their worst performer today, down 1%. Industrials down 0.5%, financials down 0.4%. Let's look at the wrap the week chart. This is the chart I like to look at, just starting the clock at last Friday's close and looking to where we are at today. So what did we learn based on the movements of the markets through the course of the last 5 trading days? Here's the S&P 500 in black, which finished the week up 0.7%. Earlier in the week, as you can see, Tuesday, Wednesday, a little stronger. We're up over 1%, but now we're kind of settled back in here. So not a bad, not a horrible week by any sense, but sort of continuing this upward trend, but a little lower, maybe slower pace than what we've seen previously. A couple of these things actually outperformed the S&P this week. This is the dollar ETF, the UUP, which finished the week up 1.2%. In purple, we have small cap stocks. The Russell 2000 finished the week up 1.5%. In brown, this is crude oil prices up 2.3%, the best performer of the bunch. And it's so interesting. When we look at energy stocks, talk about a sector we've really forgotten. I mean, and it's been just an underperformer for so long. Starting to see some, certainly basing patterns and rotation, off of previous lows. Crude oil prices accelerating to the upside. Certainly seems like that would be part of that bull thesis. We'll see if there's further follow through into next week. Everything else underperformed the S&P this week. These two are about the same. This is bond prices and gold prices, right about the same, up about 0.4%. So not a horrible week, but not a huge one. The rest were actually down. Here in in pink, we have the NASDAQ 100 down 0.9%. In blue and in orange, these are Bitcoin prices and emerging markets, both down about 1.6 to 1.7%. Let us look at a daily chart of the S&P 500, just sort of check in on where things are at and what happened through the course of this week. So when I think of this week, sort of reflecting back here, sort of the left side and the right side of this week, I guess. At the beginning, we sort of had this move to the upside, sort of continuing the uptrend above 4,500, above 4,550. Wednesday, for now, the high water mark of 2023. We made a new swing high above 4,550. But then the last couple days sort of closes below the open. I feel like we whimpered into the weekend as opposed to, a big exclamation point bullish sort of sentiment leading into the weekend. This is a little more of a tripping into the weekend sort of feel. So it's hard to feel super bullish based on the short-term movements we've seen over the last couple days. And what's interesting is some of those sectors some of those stocks that have been doing particularly well, like Apple pulling back going into the end of the week, Amazon still featuring a bearish divergence, kind of rotating lower. Others like American Express showing kind of a similar pattern right now. So you're seeing things that had been overbought. The S&P 500, of course, was overbought into Thursday's session, but then coming back out of there, setting us up going into next week. Of course, we have the Fed meeting. We have a huge potential catalyst that could certainly drive risk assets to the upside or the downside. So for now, I think the environment is a market that has had an incredible run, certainly overextended and overbought by most metrics, depending on what area of the market you're looking at, particularly the major benchmarks. Pulling off a bit going into the weekend. The question going into next week, do we see further deterioration? What's good about technical analysis, the charts kind of tell you when that's happening. You don't have to guess necessarily about what may come next. Watch the charts, develop a methodology. Think of a line in the sand at which you would acknowledge that the trend is no longer what it was before, and make sure you focus on that level. Set an alert to focus on a key level like that. Let's look at a couple individual names here just to finish things off. I wanted to highlight Etsy. I like featuring candle patterns randomly because I find a lot of times these are sort of interesting ones to hit on just to keep us fresh thinking about candle movements and what they mean. Do you know what candle pattern this is? So the narrative is we have an uptrend, we have an open, we have a long upper shadow, and no lower shadow. The open and close are almost at the same point at the bottom. So you actually could label this one of two things, and I think I'd probably give it to you. Option one would be a shooting star candle, which is when you have an uptrend, you have a big, open and close at the lower end, and the long upper shadow. Think of it as a shooting star. It's kind of visually what it's meant to look like where it comes down here. Now, a shooting star candle, the open and close aren't identical, but they're pretty close. Now this, depending on how you have your chart formatted, the open and close are really, really close. So that actually might look more like a doji candle. You'd actually call it a gravestone doji. And that's about as ominous as the name would describe. That basically means, again, indecision. The open and close are at the same point. You have this long upper shadow, and it usually suggests that the uptrend leading into that pattern probably exhausted. You'd expect short-term downside for the next 1 to 3 bars. So always interesting to see a chart like Etsy, showing some short-term weakness wrapping up this week and going into to next week. And again, think about what happened. We opened around 96.70. We traded all the way up to 102, but by the close, we're right back to the open. So sort of like an inverted V on the chart, on an intraday chart, where you rally and then there's no one left. Buyers are exhausted, anecdotally. There's no one left to push the price higher, and the price starts to come back down. So kind of a short-term, weaker signal there for Etsy. IPG is one that gaps lower, and I'm thinking, I forget who it was. It was Gann or some Gann-like analyst. I forget who it was who talked about in an intro to one of their books on commodity technical analysis or technical analysis for commodities, talked about why they invest in commodities and not equities. And one of the big bullet points they highlighted is the company risk, right? When you look at a stock like IPG or any other equity, there is a risk that there will be a company-specific issue that causes a huge gap. Now, most often we think of earnings as being one of those catalysts. We're now in the midst of earnings season, so you're going to find these gaps that are way more prevalent than they would be at other times in the quarter. And what happened is IPG gapped down quite a bit, around 13%. So what do you do in this sort of environment? So what you have to remember are a couple different things, right? A lot of trailing stop techniques like a moving average, like the chandelier exits, like a parabolic system, pretty much all of those are going to be triggered when you have a gap down like this. If you weren't already triggered by the pullback you had over the last couple trading sessions, today most likely going to trip that. And so it's one of the risks of buying equities. You have to remember that the value proposition that you have owning an equity is you have the potential for greater return because you are taking on greater risk. And you have to remember that that's the risk versus return that you have to think about with stocks. So you're always taking on risk when you own anything other than a treasury bond, right? You're taking a risk that something happens to the company, to the sector, to the market, some macroeconomic issue, some geopolitical issue, whatever it is, could cause the price to go up or certainly down. And you're seeing that sort of gap here. What's interesting about the chart of IPG, and again, I think on gap days like this, you always look to the left and see where we're at relative to where we've been. This gap pushes IPG below the 200-day moving average. I think that's sort of a potential issue. What's interesting now, though, is you're right at previous support. The March and May lows are right around this same level. So I don't know if it's a coincidence that we gapped down and kind of settled in right around those lows. We're also oversold for the first time since that March low. Do we get a counter trend bounce going into next week? And I think that might be an interesting chart to watch as a result. Maybe time for one more chart here before we bring on today's guest, and it's Zion's Bancorp, Z-I-O-N. Looking at regional banks like Zion, Key, and others, and you can see a lot of them had a nice thing going until today. If you look, it's a bit of a bearish engulfing pattern with the gap higher yesterday, but today opening above yesterday's close, closing below yesterday's open. We were overbought yesterday, and now we're coming out of that overbought region as we essentially failed to eclipse the 200-day moving average. That is not a good look from a technical perspective. You're thinking about these banks in basing patterns, right, with clear resistance levels that we've overcome. Overall, I think there could be more upside to be had, but this sort of pattern as we're testing resistance really speaks to short-term weakness instead of short-term strength. Maybe we're setting up for a bit of a pullback on a chart like Zion, potentially setting us up for a higher low. But as always, focus on the chart, see what the chart is telling you about the what may come next. Okay, we've now wrapped the week. We're going to come back with Jesse Felder, editor of the Felder Report, over in our interview set. Hello, everyone. I'm super excited to sit down with Jesse Felder of the Felder Report. Before we bring Jesse on the show, a couple quick announcements. First off, we love hearing from you. Our mailbag is fueled by viewers like you sending in your questions as you are trying to analyze the markets using technical analysis. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. And if you're watching this on YouTube, just drop a comment right below the video you're watching. We would love to hear from you. We're actually going to do a special mega all mailbag show coming up next week. And we love to feature one of your questions live on the air. So don't forget to send your questions to us via email, thefinalbar@stockcharts.com. Also, just to remind you, a really good special happening right now at stockcharts.com. We have a free version of the site, but the real power of the site is for our paid members. We have the ability, and you will have the ability to analyze the markets and identify ideas using our award-winning scan engine, using our chart list feature to save your ideas, save your notes and thoughts and annotations about the charts of interest to you, and also use all the capabilities of the advanced charting platform ACP. You can go to stockcharts.com/special for all the information. Great time to join Stock Charts. And if you're an existing member, you can sign up now and actually extend your membership at the current low level. So go to stockcharts.com/special. I want to welcome on today's guest, Jesse Felder. Jesse's the founder and editor of the Felder Report, normally from Sedona, Arizona, today live here in Redmond, Washington. It's so good to see you and meet you in person, Jesse.
You know, I'm super excited to do this. I've been a Stock Charts user for 20 years. And so, and we've been doing this, you know, you've invited me on a few times. We've been doing this for a couple of years now. So it's great to be here and see behind the scenes, and it's very impressive. So
it's super fun. And I appreciate every time you come on, I feel like you're one of those guests that knows and uses stock charts better than I do. So I always take some notes on the charts that you send over to me. We're going to talk about precious metals. It's interesting how, you know, gold and silver had such a run and then sort of stabilized a little bit, sort of took a bit of a pause. Now we're actually starting to see maybe a re-exertion to the upside. Talk us through where you're at with gold. What do you see?
Yeah, it's, the first chart here is a long-term monthly chart of the gold price. And you can see, it's essentially testing, or has been for the last few years, been testing that 2011 price high that marked kind of the end of the last bull market for precious metals. In the process, it's found, formed a, the way I read it, a cup with handle pattern. Pretty massive, more than a decade long it's been forming this, and the last couple of years represent the handle of that pattern. I've heard some people talk about potential triple top in the gold price and potential for a major reversal here. But that's why I added some of the other charts. I think when you zoom in and look at the weekly chart and some of the sentiment signals, it looks a little more bullish. To me, over the last couple of years, really since that 2020 price high, it looks like we formed a bullish flag pattern where we had kind of the breakout in 2018-19 and into the COVID 2020 timeframe. But since that 2020 high, looks to me like kind of a bullish flag pattern that we broke out of in the last several months. So this is actually just a shorter term view of the monthly chart pattern. But what I'm most excited about right now is that with this kind of testing of new highs, there's been zero interest. All the types of sentiment signals that you look at don't show the type of overexuberance that we've seen at the other price highs. So to me, that's very bullish for continuation here.
It's so interesting that you've seen gold, just in the last, I guess, 6 to 8 months, really appreciate along with stocks. How do you think about the movement in gold as, people love to think of it as a safe haven, but you find that stocks and gold actually move together, they move separately. How do you think about it in relationship to equities, obviously, that have had a pretty good run already?
I think they both are looking forward at, the Fed's rate hike this month. The Fed has communicated they're going to raise probably again this month another quarter percent. And so that's kind of emboldened stock market bulls to believe that maybe the rate hiking cycle is going to be over.
Right.
Gold operates kind of on the same wavelength there, that the rate hikes have been one of the major causes of dollar strength over the past couple of years. That's kind of represented a headwind for gold prices. So when the Fed is done hiking, it could potentially be very bullish for the gold price. If you look back to that 2017-18 timeframe, last time the Fed was hiking rates, and then into the end of 18, we saw that the famous Powell pivot.
Right.
Was when the Fed was done, then that was kind of the green light for gold to take off again. So I think that's what gold's looking at here, is if Powell's going to be done again, potentially, relatively soon, that's the green light for gold prices to take off again.
You mentioned sentiment. I want to get to your third chart. This is an index I actually didn't know we had on the Stock Charts platform, so I'm so excited that you brought it. Can you describe what this is showing us and then what it's telling you about the situation?
Yeah, in the upper half is just the gold price. The lower half is a sentiment signal that I've looked at for many, many years to help understand kind of short-term trading patterns in precious metals. It's essentially the premium or discount, and it's pretty consistently a discount in recent years, of the Sprott Physical Gold and Silver Trust relative to its net asset value. So right today, it's trading at about a 5% discount to NAV, which tells me, I don't know of any other way to go buy physical gold and silver at a discount to its, the price it trades at in the open market.
Right.
So via a closed-end fund like this, you can essentially have access to precious metals at a 5% discount. When that discount has become this wide as it is today, usually that lower line that I have on the chart is about at the 4.5% level.
Okay.
When the last 5 years or so, every time you've seen the discount widen that significantly, it's been a pretty good time to buy this fund. It basically is an indication that investors are pretty pessimistic. They're willing to sell the fund at that large of a discount. So to me, that's a really good sign. If the technicals are starting to suggest that we've broken out of this bullish flag pattern or pennant, and sentiment is not overextended to the upside, that to me is a good recipe for continuation. It's
really interesting. Gold at a 5% discount is what it almost reads at, right when you're thinking about it. It's really fascinating. It's interesting that we're seeing these signals from gold, and again, what we tend to think of as a fairly defensive area of the market, versus growth stocks that have had a pretty good run. When you look at the conditions now, we've been profiling on the show the last couple weeks, a lot of divergences, a lot of signs of the market being overextended. People can talk about the market being overvalued, I feel like, for quite some time now. What's your perspective on growth stocks that have had such the run that they have? Is it time to be lightening up in that area of the market and maybe increasing exposure to something like gold, or how would you relate them?
Yeah, no, I think it's interesting to see that, last year energy, or the last couple of years, energy was the biggest winner in the market, 21, 22, and tech stocks really faltered in 22. I think there's a rotation there, and energy's been the laggard this year with tech stocks leading. And I do think that it's not just precious metals. Oil's starting to look interesting again. I think the whole commodity sector momentum is starting to shift, bottom, and potentially set the stage for another leg higher. And that would probably come as a rotation, again, out of tech and some of these popular things in the stock market back into more hard assets and commodities. So I think that we could be close to that type of another rotation.
It's I love what you just said. When you're thinking about some of these names that have had really good runs, and we talked about Apple in our market recap. I'm bringing up the chart of Apple. Apple's one of those that it just keeps going higher, and I feel like all along the way we can have reasons why it shouldn't, right? Because it's overextended, it's already gone up a lot, but the market continues to go. In your process, when you're looking at a chart like Apple, how do you manage risk? How do you sort of try to lock in gains and minimize downside on something like this that has already had one? If you're holding this, I'm sure you're starting to get nervous. Like I don't want to hold on too long. So how do you think about that?
Well, one of my biggest mistakes I make is selling too soon all the time. I was a big.
At least you're honest about it, though, that's good.
I was a big buyer of Apple back in 2013 timeframe, 14, after Steve Jobs passed away. The stock traded about 5 times cash flow. It was incredibly cheap. Everybody thought Samsung was going to own the world. So sentiment was extremely bearish towards the company, and it was extremely cheap. Had a good margin of safety from a valuation standpoint, and you started seeing technicals. I learned a long time ago it was one of the reasons why I first got my stock chart subscription, was to not try and catch a falling knife, and so to look for something that's potentially showing signs of bottoming is important. But I'm not great at holding on to these things once they start to run, and I haven't owned Apple for the last couple years. I do think the biggest risk to Apple and a lot of stocks in the group is that the forward PE ratio now for the NASDAQ 100 is getting close to about 30. The 10-year average is about 20. So, and those are based on analyst earnings estimates that have really been very aggressively raised in the last couple of months. So if Netflix and Tesla are representative of what we can expect this earnings season, it's not going to be great for companies like Apple, because I do think maybe expectations have gotten ahead of the reality for earnings over the next couple quarters.
Talk us through how you approach next week with the Fed coming up. It seems like a rate hike is sort of priced in, and that's what expectations are. What do you do during a Fed week? Is there a way that you approach it in a certain way? Do you tend to lighten up and just wait to see how things play out, or what's going to be top of your mind going into next week?
Yeah, my time frame for trading is for individual stocks, is probably a several months to a 2 to 3 year time frame for trades for me. So I'm not trying to position too short term around those types of things, but I think it'll be really interesting to hear them talk about the fight ahead of inflation. If they start giving signals that the last June CPI suggests that they're getting close to being done, that the market's going to take heart, in that sort of language. I think we're more likely to hear that the Fed, is going to continue saying what they have been saying, which is interest rates are going to have to stay high for a prolonged period of time to be sure that inflation comes down in a sustainable way. If that's the case, you look at things, one of the quarterly charts that I've been looking at on my stock charts lists is the SPY to TLT ratio. If you look at quarterly RSI, we're about as overbought as we've ever gotten in terms of, for SPY and QQQ relative to the bond market. So that tells me either interest rates have to come down to kind of support stocks. If interest rates don't come down, stocks are probably significantly overbought and need to have a correction. So all this language from the Fed over future direction of interest rates is really important, I think, to the stock market.
So just to finish up here, Jesse, obviously the S&P sort of pushing above 4,500, pushing above 4,550, now kind of ending the week right just below those levels. what would you need to see? Of course, the trend has been positive. What would you need to see to say, okay, this is now changing, and this is where we need to start thinking defensively? Is there a particular signal for the major averages, the S&P, the NASDAQ, that would trigger that sort of thinking for you? What would you be looking for?
Yeah, I think I like to look at certain momentum indicators, and I think using the PPO is a way that I like to do that on a daily and weekly time frame.
Okay.
Because you can see momentum structures, right? You can see when the PPO remains elevated, creates a channel. When it breaks down out of that channel, it's kind of like a trend following type of signal. It's kind of like looking at moving averages. And so using PPO on a daily chart, with a metric of 50, is basically like price relative to the 50-day moving average.
Right.
That type of thing. And when you see, a momentum structure break down, and I think we're seeing, that in QQQ right now, where this uptrend in momentum is potentially rolling over. And once that momentum structure is broken, it tells me that something has changed. And so that's something I'm paying close attention to on that time frame.
It's well said. Jesse, listen, it is such a pleasure to meet you in person. Really appreciate you coming on the show frequently, but it is so good to see you here live in the studio. Thanks for coming and stopping by. I hope it's not the last time.
It's been an absolute pleasure. Thanks for having me.
That's Jesse Felder. Jesse's the editor of the Felder Report, normally from Sedona, Arizona today. Super excited to have him live in the studio. Folks, we have to wrap the show. Go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We're looking at the S&P 500 in the top panel, 2 other data sets as well. And I kind of took these off of one of the charts I have just called The Chart. I was asked years ago, what does the chart say about the S&P? So I created a series of indicators. I said, here's the chart. And I found just updating that a couple of times a year has been really helpful, just to focus on the key metrics that I think help me make sense of the current market conditions. The S&P in the top third of the chart, of course, going higher, breaking out to a new swing high in May, making a new high for the year, and then continuing with a pattern of higher highs and higher lows. Second one down is the advanced decline line for the New York Stock Exchange. So large cap breadth, looking at the 80 line for the S&P 500 has already broken out. You're also seeing that for mid caps. Small caps are one that have not quite done it, but as of the end of this week, it looks like the advanced decline line for the New York Stock Exchange maybe just barely breaking out, finally above that February peak. That's been one of the big question marks for this rally, is a lack of breadth support. I think over the last 6 weeks, you've seen more and more in that. For now, the 80 line for the New York Stock Exchange appears to be making a new swing high. Here's the equal weighted S&P, also threatening to make a new high above that February peak. As I see these testing the February peaks next week, I'm very curious to see if those breadth conditions continue to improve. Chart number 2, utilities. There was a great discussion with Jesse Felder about an area of the market I think people have been under-focused on, materials, thinking about precious metals, energy, other areas of the markets that have been lagging behind the growth leadership. Utilities is one sector that has certainly been struggling on a relative basis. This top panel is showing you the relative strength of the XLU versus the S&P. This is on a weekly chart. I like looking at this set of weekly charts and focusing on the relative strength. Utilities, the top performing sector, a couple days this week, that's creating this little blip in the relative strength here and in the end. We see that trend continue. For me, I would be skeptical of further upside for our major averages if a defensive sector like utilities really starts to outperform. Finally, do not forget the benefit of short-term indicators like candle patterns. I am more of a medium-term, long-term investor. I know my guest today, Jesse Felder, is sort of in that same bucket. However, I have found there's a lot of value in understanding the tactical time frame, the short-term movements that comprise those medium and longer-term trends that we're trying to cover. Zion's gapping higher on Thursday today, opening above yesterday's close, closing below yesterday's open. That is the dreaded bearish engulfing pattern, usually only telling you about the next 1 to 3 bars. But when I see patterns like this popping up on regional banks, I'm a little skeptical about further upside going into next week. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. I will be out on vacation next week, but we have some really cool special programming, some guest hosts, top 10 charts to watch in August 2023, and a special mega mailbag episode. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great weekend.